Hello. Hi.
Hi.
Nice to see you. Hello. Thank you so much. I'll just give it another minute for people to log in. Okay. Um, so thank you for joining me. I feel like it's been a bit of a rough time last couple of months, 2 months. So I feel like I've had a bit of time to rethink about what I want to try and do going forward. So I'm going to break this up into three parts. I'm going to acknowledge some of the mistakes that I've made. I'm going to talk about some of the things that I got right. And then I'm going to talk about some of the things that I feel like optimistic about going forward. So, some of the mistakes that I made, things that I'm not quite sure if they're a mistake or not. But since the stock is down, I'll talk about it now and we'll see. So, in my mind, Gearcal Technology is one. Also had other businesses that, like Auster, that I felt were doing well, and then they kind of did an about turn. And so I'm not 100% sure, even today, with recording this in September, that Gay Cloud Technologies was a mistake. I'm not 100% sure there. The stock is down a lot since the last earnings report, and that's been painful. And I feel, I don't want to blame anything on anybody, but I feel like a lot of investors, retail investors, got caught up in this one because Seeking Alpha was so passionately promoting the stock that when the share price started coming down, together with the risk-off sentiment that happened about July, August time, this led the stock to start losing momentum. And once it lost momentum, then the Seeking Alpha algorithm would just highlight the stock as going from a buy to a hold. And this exasperated the situation. But I'm not 100% sure whether or not I made a mistake in that part. But it's more painful because most of us already had considerable gains here. And the same with Auster, and the same with LifeMD. And, a lot of these stocks, they were having really strong returns in the relatively short period of time. So this is something that's gone wrong that I've reflected on. What's gone right? As I look at the equally weighted portfolio, I looked at this before coming on the meeting. The equally weighted portfolio is up 20% versus the S&P, which is up 18%, and NASDAQ is up 17%. So the equally weighted portfolio has done better than the index. The cash portfolio, which is what I actually do, that is down 1% from the S&P and about 50 basis points higher than the NASDAQ. There's a tiny bit of 2% difference in the hypothetical portfolio and the real portfolio, but that's just it's difficult to equally weight it precisely. But for all intents and purposes, I'm not going to cry over 2%. So those are some of the things that I believe have gone right. What I want to try and do, and this is a work in progress, is I'm going to improve the strategy. So when I've had difficult periods, for example, in the fourth quarter of 2018, that was pretty difficult for me. And I had to adapt back then to my investment strategy. And then I also had to change the way that I invest after 2022. And every time that you go through these difficult periods, if you're not adapting to a new investment style, you're not going to last in this game. This game is rather brutal. And if you're not destroying your most cherished ideas, you're not learned anything. And investing is a really enjoyable experience because it gives you an opportunity to learn as you go. And if you're right, you can make a considerable amount of money from it. And I know you can. And you have to, it's kind of complicated because you have to have really firm views on certain things. But at the same time, you have to take an unpopular view. So when I recommended to exit Palantir, it was like, I was an unpopular view at the time. And since then, I recommend to exit at $27, and now it's at 36. So obviously, I left a massive amount of upside. And that's an unpopular view. Same last Friday, when I recommended that we exit AppLovin, I recommended it, and it's kind of continued to move forward. That's an unpopular view. But I know this game really well by now, and it's not about trying to get out of the top. And that sounds great. And it's really easy to talk about it after the fact, write up a book, and how you called Palantir and you got out whatever price. But this is a game about surviving. And I take it quite serious to people that have been with me in this journey, because over time, I've developed some close relationships with people, and I see that people trust me, and I want to be loyal to those people. So I'm always trying to be transparent and say, listen, this is what's happening. This is where I've made a mistake. This is where I'm going to reflect. And that's what practical advice I'm going to take going forward. So one of the things that I learned in 2018 was the importance of averaging out the positions, having each position equally weighted. And this has paid massive dividends this year. But it was a journey that I had to go through. And this reflection period that I've had now in the summer, I really hope to crystallize this a lot more. And the way that I'm trying to think about it is like this. So back in the day, Ben Graham would do this kind of style of moving a lot of rocks around, a lot of stocks, rocks, they call them, and just kind of finding things that were disproportionately mispriced. He would capture 20, 30% and go. And this has a lot of churn. And in the past, I felt that the churn would have annoyed many people, because what happens with the churn is that people become passionate about names that are winning. For example, when AppLovin is doing well, people are like, oh my God, I can talk about AppLovin, and they feel great. They open their portfolio, AppLovin's up, and they're like, yeah, kind of hands in the air. And I didn't want to take that away from people. And I kind of felt, okay, yeah, let's kind of keep it up, because it's doing well. But at the same time, I'm very mindful that it's not about those individual positions doing well. It's about the whole portfolio doing well. Because people don't want to follow me into an investment and have, let's say, something like Palantir or AppLovin is up, let's say, 150%, and then two stocks that are down 30%. People feel frustrated with that. People are like, oh my God, this is awful. So what I'm trying to do going forward is I will, in the new stocks that I recommend going forward, I'm looking forward to recommending new ideas, is that when the stock is up about 45%, 50%, I'm going to recommend that we exit. And that will frustrate people, but you can't make everybody happy. You know, I tell my daughter that anything worthwhile doing is difficult. And if I give her that advice and I'm not taking that advice myself, you know, what kind of legacy I'm going to leave? So I need to do this to drive the portfolio forward. And I know the drawback of this because I've been in this period before. I've been like this before. The downside of this is that there's going to be a period in the market where interest rates are coming down and buy and hold strategies come back to the foreground. Everyone is a buy and hold investor. And then, you know, inflation goes this way or that way, or Elon Musk says that, and the markets go a bit more sideways. And then everyone's like, oh, no, just take the capital off the table and go somewhere else, you know. And you can't always adapt to every single market condition by changing your portfolio strategy. But I believe that if over a 1 year period you end up outperforming the S&P, that gives your strategy a lot of credence. So I believe that people will have some confidence in their strategy when they start to see their own portfolios, because, you know, whatever I'm doing doesn't really matter. It matters what the stocks that they follow and what they're doing. And by extension, it's worth noting that sometimes some people pick out 2 names from the portfolio or 3 names, and they put 10% of their position in, and they buy loads of options around it because it's like sounds really like it's going places. And that's that person's strategy. I say buy 5 stocks, equally weight them, sit on your hands for 12 months. What people are doing something completely different. And the example that I provide to this is if you're making a lasagna and you kind of put all the ingredients in the packaging in the oven, try and speed it up, and it's like, oh, it didn't come out how I was hoping it was going to come out. Some things take time. You know, the Buffett quote is that you can't speed up a pregnancy by making 9 women pregnant. Some things just take a bit of time, and you know, there are good periods in the market and bad periods, but the strategy is equally weight and be agnostic about the underlying business. Because, you know, there are some CEOs that are highly vocal, and, you know, right away come to mind Palantir every other day on CNBC, upping a stock. And there are other examples, someone like Uplovin, the dude doesn't say a word. Even when I tried, like doesn't say anything. And the stock has done equally well. So it's difficult to, people fall in love with narratives, particularly when the share price is going up. It's so easy to build these narratives up. It's really easy. But when the share price takes a breather, the narratives go to the downside and everything is wrong. And people are quite emotional. And I've invested for a long enough period, and I've been doing this for enough time to know wholeheartedly that investors love to buy what's working this week, and, you know, they will sell when they get a bit anxious. But I'm trying my hardest to say, listen, if you equally weight them, even with gear cloud technologies, if you equally weight them, and even if I'm wrong and the stock is not worth $60 and it's worth, like, I don't know, $15, which is trading for today, like, even if I'm wrong, it, like, there is a margin there, right? So let's say a person bought the stock at like $25 or $30 and it's down to 15, they're down 50%. That's 2.5% of the overall portfolio. It's not going to cause too much heartburn. What causes people a lot of anxiety is that they follow their own strategy. And then they say, you know what? It's not working for me, and I'm like not feeling well, and this and that and the other. And it's difficult during these difficult months sometimes to see, you know, further than the fog. And when the market kind of starts coming back a little bit, and things suddenly start coming back up quite quickly, like like hims and hers and other things, samsara and everything. Like things start working out and Robinhood, and people are like, oh, you know what? Actually, the portfolio does work, and I'm back in it. And it's like that. Just what is happening is that the person is mistiming the whole situation. If you think that your portfolio, you're trying to, since what I say I can do is trying to compound by 15%, and the stock from the start of the year to the end of the year is up 30%, but because the person's mistimed this, they only end up with 6%, they feel pretty disgruntled, and they've lost a year that they could be doing, slightly better. So just to summarize what I want to say is that, more often than not, and I know this is so much easier said than done. I know that this is easier said than done, but more often than not, sitting in your hands for a little period of time can actually be quite profitable. And I'm telling you, like, it really works, because it's mass panic. And often, for example, I'm thinking of gig technologies because it's stuff that so many people reached out to me about. More often than not, the results will come out in when would they be? Middle of November, let's say, because it's small cap. The results will come out, even hypothetically, they miss all analyst estimates. I know from experience that because the stock has been so brutally killed for so long, that even when they miss estimates, the share price just rallies. People are like, oh, it wasn't actually that bad. And that cloud, that fog is removed. But most of the investors that bought high sold low because they got anxious. And I'm trying my best to give people confidence to sit on their hands and, to navigate this period. So yeah, that's kind of what I want to talk about. I want to open it up to maybe some Q&A if anyone wants to ask any questions. Really hoping to give people that are a bit nervous or whatever a bit of a hand-holding experience. So if you want to ask any questions, this is a really good time.
Can you hear me?
Yeah, very well.
I'm more of a buy and hold. Let your winners ride. Like I'm looking at my portfolio right now. One of the stocks I've had, VST. I'm up like 350%. But what if I had quit at 50%? I would have lost 300% upside.
So, A, I don't know that business. But B, I would say relative to how often it happens, first, how often that recurs. Secondly, I would say it depends on the holding period. Let's say hypothetically, I don't know. I don't never heard of this business, but let's say you've been holding that business for 5 years. That is a terrific return, no doubts about it. But is it an outlier? That was my first question. Because everyone remembers the winners. Everyone remembers the winners. And that's why I make it a massive effort to always say, listen, this is where I'm wrong, this is where I'm wrong, and this is where I'm wrong. So that, to pound it in, because that's really where you learn, right? It's really, you learn by recognizing times when things didn't work out. And I'm happy for that. I know you own NVIDIA. Like that's cool. But I have to follow the strategy that makes sense for me. What I have a strong conviction of, and what I am willing to say and underwrite. Does that make sense? I need to believe in it so that I can do it. You know what I mean? The likelihood of me finding the next NVIDIA or whatever is relatively small.
Right, but what about trends? Because right now, I was listening to Barron's podcast. Right now, there's a great need for power, energy, data centers. So VST is at the forefront, but I've had it since 2021 or two. But there's CEG, TLN, and PEG, 4 companies that are going to, because of the need for energy, are at the forefront of this
demand for energy. Yeah. So I have been on that idea for too long, and for too long I've been trying to capitalize, because it's not a new idea for me, about the demand for electricity to meet the demand for data center and cloud capacity. It's not a new idea. I've been with this idea for a long time, and in my experience, I have not had a successful experience in this. My experience has always been investing in nuclear, and it's actually ironic that I've had that idea, because I just saw a podcast or whatever by Larry Ellison from Oracle, and he's like, oh, like we're gonna need like so much nuclear power, and it doesn't matter, like if the market is not waking up to that belief, anyone can spit whatever story makes sense. You need people to be willing to, I've been on that idea. It's not a new idea for me, but I've not seen anything to see a material pickup in this thesis. I've heard a lot of talk about this. I study a lot about energy. Vakel Smil is a physicist that's, I opened my eyes to this idea. Many books. Is Bill Gates' favorite author. And, it's just so eye-opening that we massively need a lot of investment in energy infrastructure, not only for the data centers. That's the one that people love to talk about, but there's more to it than that. Simply EVs is going to be a dislocation from, how we fuel our mobility. And also, importantly, it's something that people are not really thinking about, but there's a movement towards decarbonization. And this is something that people talk a lot about, but I haven't seen a lot of action. So it's being early, in my opinion, is the same as being wrong. I've been with Uranium Energy Corp because I believe in this idea that you're going to need a lot more nuclear demand. Uranium basically goes to make nuclear energy. But so far, this is just a thesis and it hasn't really played out. So to conclude, oftentimes people say things that sound smart, but you need to know which game you're playing. Are you in the game of trying to sound smart, or are you in the game of trying to make money? And it sounds crass to say that, but if you don't know which game you're playing, you're going to end up fooling yourself. And I find that we're the easiest people to fool. So yeah. Let me just take a question, if you don't mind. So yeah, about tariffs, man, listen, on Gigacloud Technologies, this idea of tariffs is always floating around, it's quite difficult to impose tariffs on small goods because it's a lot of paperwork, it sounds like catchy, if Trump comes in, it's going to be tariffs all around and this and that and the other. But it's actually going through the effort of doing the tariffs for a lot of e-commerce is actually quite rather difficult because a lot of these goods, for example, I'm thinking about Gigacloud Technology, a lot of these goods don't have a lot of value. They're bulky items, but it's not. So it's difficult to go through all the paperwork. And, I've heard this idea and I'm like, okay, yeah, let's see if it actually happens. And at this point in time, like that is not the overwhelming thesis. The overwhelming thesis with Gigacloud Technologies is solely that people believe the company to be a fraud. That's it. Like it's really, there's no other thing. And if they want a fraud, then why don't they have a US accountants on it? And I've heard this thesis and I'm like, okay, yeah, sure. But if Gigacloud Technologies is a fraud, how do they make their business run with no debt? How do they have so much cash? And how are they buying back shares starting next month? Because they have to wait till the window's closed. yeah, I'm biased because I've owned this stock for a long time, and but I'm being honest as well that like I don't think that is really the main thesis here. Oh, what's about tariffs? Like that's not something that I'm concerned about. But I thank you for your question. So I had a think about how would you protect your portfolio against geopolitical risks. I had an idea last year that if there was going to be any type of, let's say, geopolitical risk, I wanted to see opportunities in my portfolio that would benefit from that. One idea that I had was Palantir, because I believe that, hey, if there's going to be any kind of situation, they're going to need a lot of analysis. So I had this idea in early 2023, and now that has played out. I don't have anything in the portfolio to protect for that right now, but this is something that we'll definitely consider and going forward. There's always a risk of something. There's a risk of cybersecurity. There's a risk of interest rates. You investing is a lot harder than it seems. It's really easy in hindsight, but it's actually quite difficult on a go-forward basis. So I don't have a really good answer for that one. Does anyone else have any other questions they want to discuss? Okay. Do you have a question, Budimpa?
No, I'm good. I'm good. Thank you.
Are you sure?
Yeah. Well, I'm just buy and hold, like I said, and I probably get burned more. Well, no, I think I make out actually, like app. I know you said sell.
Mm-hmm.
And actually I subscribe to another service, so it's on their strong buy list.
Mm-hmm. May I ask you a question objectively? I spoke to you. It was it was early September because I recommended the stock in 23rd of August. And your discussion with me at the time was, oh, I don't want to buy up because it's at an all-time high right now. And you don't need to tell me the price you bought. Doesn't matter. That's no here, no there. But remember when do you remember saying that you weren't really interested in buying it because it was at an all-time high? Okay, it doesn't matter. Maybe I misremember.
Let me see.
Just continue. When you hold a stock right now, if hypothetically you had said that, or someone said that, okay, I don't want to buy the stock because it's all-time high. If hypothetically a person had said that, you not selling is the same as me. I'm like, oh, that's an all-time high. I don't want to buy that. So if I'm not willing to buy and you are not willing to sell, like it doesn't make a lot of sense because you need somebody to come in and buy it, right? You need somebody to look at that and buy it. Now, let me just say one thing about AppLovin. I very much like the business. I have nothing negative to say about it. The only concern I have is that I believe that advertising right now, because of the election year, is going to be very, very strong in Q3 and may fall in slightly into Q4. This will lead to some abnormal seasonality for Q3. And I'm concerned that people may see some level of deceleration in the revenue growth rate into Q4. And when they see that deceleration, they're like, oh, the show's over. And all that momentum that everyone's buying right now, everyone, like Seeking Alpha is promoting this as the number one pick and this and that. Everyone is on the bandwagon jumping on this now. But I'm concerned that if there's any deceleration on the growth rate, all of that momentum will just fizzle out. And I don't want a round trip. So I'm trying to learn from my past mistakes. And even if the stock, now it's around 110 or 120 or whatever, even if it goes to 200, that's okay with me. I'm already kind of thinking about other opportunities. You're never going to get out of the top, but you have to be mindful. Every type of investment, whatever the investment, there's a risk and there's a reward. You're making a bet on an outcome. You don't know, it's an uncertainty, right? You're making a bet and there's a probability that it goes up or not, And oftentimes, even if the results are immaculate, look at Broadcom reported 2 weeks ago, even if the report is immaculate, the market's like, okay, I'm not going any further with this. So you have to make an assessment of the likelihood that it continues to be in so much favor as now. It might be, it might very well be, but I have to be quite cautious about that. And I feel like I have a duty to people, to try and improve the performance of the portfolio.
Yeah, I did get it in August, but then generally what I do is I don't buy it all at once. Each month or every other month, 3 months, I just keep adding a little bit to it. So my average cost is like $48. I did buy August 15, 205 shares, but I add a little bit so that my cost is not like, that way.
Yeah.
If it drops, you don't hurt as bad. And if it goes up, it's not as great, but it's still, I'm up 152%. And right now, I think I'm going to let it ride.
Okay.
But it's good to know, as you're saying, that things could slow down as the election is done and advertising drops. So
yeah, it might work out, and it probably will work out. I really like this business, and it's such a rare business that is, I believe, up to a certain extent, quote unquote, under the radar. Everybody knows the trade desk. Wow, the trade desk. People love the trade desk, but the market cap of the trade desk and AppLovin is now approximately 10 billion apart. And AppLovin is relatively still unknown. So these are known names. Sometimes can do quite well, and I really hope it does, because I feel like the CEO and modest person, and I like that a lot. But I have to think about what I'm trying to do. Just let me answer one more question here. Sorry, about MoneyLion. So the way the MoneyLion's business works is that they do a lot of loan origination. That's kind of a fancy word. They're essentially lending out money in a short period of time. But for you to lend money, you have to borrow money. So with interest rates coming down, I'm very much hoping that the amount that they'll cost to borrow that money will come down, so their margin between what they borrow and what they lend at will expand. And this should drive substantial free cash flow. But this has been my thesis for a long time. And I've been waiting on these interest rates to drop for such a long time. So, it's a thesis that has, for the majority, still not come to fruition. But I also know that to get investors back on board with a name such as a small cap such as this, it's going to take a large amount of free cash flow when they report Q3. Part of the problem here is that MoneyLion changed their capital investment strategy. They were really growing at like 18-20%, but they were making a lot of free cash flow. And they're like, actually, no, we're making so much free cash flow, we're going to grow our revenues really fast. And as a consequence, we have to reinvest back in the business. And the market hates that. The market hates it when management team changes their position and say, actually, we're going to do this now. And it's kind of like, and until it works out, you're kind of like in a penalty box. When it works out, everyone's like singing and dancing, and you have a lot of leeway to do, but but the investors typically want to see it actually play out. Okay, I don't think I've got any other questions. I'm really grateful for everybody. Thank you, Budimpa, for your questions. Thank you, Lee Jun, for your questions. Thank you very much. I really appreciate everyone coming on. And our fingers crossed for you, Badimpa. I really hope that you can get in a couple of weeks, come on here and say I told you. I really hope it works out. I really hope it works out. And yeah, and also that would be a lesson learned. You know what I mean? Just perhaps it has been a difficult period, and perhaps I'm being a bit risk averse.
Hey, the interest rate's gonna be dropped this week.
Yeah.
Woo-hoo!
Yeah, that's true. That is true. So I hear. We'll see how it goes. Well, everyone, thank you so much anyway. Thank you. Have a nice day. Thank you all. Bye-bye.
You too. Bye.